Hi. Today, we are diving into the financial results for Onward Technologies in the first quarter of fiscal year 2026. After a brief overview, we will present the key insights as shared by the management after the results. This will be followed by our estimates for the future, alongside the closing comments. As we delve into an overview of Onward Technologies, we can see how its focus across three specific industries is shaping its revenue streams. This snapshot highlights not only company's performance, but also its aspirations for growth and innovation. The industrial equipment and heavy machinery sector stands out as company's largest revenue contributor, accounting for 59% of total revenue. This sector is pivotal, with significant investments taking place globally in off-highways, energy, utilities, and industrial sectors. The company is offering ER&D services through new product development, supply chain management, and digital factory solutions. Transportation and mobility, contributing 36% to the revenue, is another key focus area. Here, the company has been aligning its services with the rapid evolution of software-defined vehicles and advanced driver assistance systems. With increased execution capability and greater role in the integration of end-to-end system design, the company is becoming a key client partner in delivering innovative automotive solutions. Healthcare and life sciences is a relatively new vertical and contributes a modest 3% to the revenue. This vertical has significant potential. The company is offering digital services related to new product design and cloud solutions that address critical needs in regulatory compliance and engineering support. This area is increasingly vital, especially since it assists clients in navigating FDA and CE submissions. Here we briefly look at the financial performance summary for Q1 FY26. The company achieved an impressive revenue of $1,332 million this quarter, representing 13.2% growth on an annual basis. Quarterly revenue growth was 4.6%. It's worth noting that the EBITDA generated was $171 million, translating to an impressive EBITDA margin of 12.9%. This is the highest EBITDA margin generated by the company in its history. Profit after tax for the quarter was 127 million rupee. Now, we will explore key insights from the recent conference call, where the management discussed company's progress and recent initiatives. As we delve into the key insights from Onward Technologies' first quarter conference call, it's clear that the company is positioning itself for sustained growth and operational efficiency. The focus has been on strengthening relationships with existing customers. This approach not only enhances customer loyalty, but also opens doors for upselling and cross-selling opportunities. Next, all three business verticals are anticipated to gain momentum in medium term. With the right capabilities in place, we can expect these verticals to contribute positively to the bottom line over the next 2 to 3 years. The upcoming opening of a new design center in Chennai is another key development. This center is set to hire up to 200 employees this fiscal, with planned capacity for up to 1,000 employees. Additionally, Onward Technologies has improved its project execution capabilities considerably. The ability to initiate projects within 4 to 5 days, down from several months, demonstrates a significant increase in operational efficiency. This agility will likely enhance client satisfaction and project turnaround times. It's also important to note that external factors, particularly challenges in the automotive sector and supply chain issues, have impacted revenue growth during the preceding year. However, the company has built robust execution capabilities over the 12 months, positioning itself to better manage these challenges and tap opportunities moving forward. Lastly, the focus remains on time and material projects, which accounted for 89% of revenue. It's clear that the company is envisaging good growth across key verticals, particularly in the automotive sector. This optimism stems from the recent challenges faced by the automotive industry and how the scenario has stabilized in the past few months. The company's guidance assumes bear-case scenario for the automotive vertical. In the next 2 to 3 years, the company anticipates rapid growth across all 3 verticals. Based on its execution capability, the company can be in a sweet spot, allowing us to see good growth at that time. It plans to increase its focus on on-site projects. Currently, on-site revenue contribution is at 28%, and by creating its physical presence near client locations over the past year, the company is looking to not only strengthen client relationships, but also enhance its service delivery. The company is guiding towards double-digit growth and EBITDA margins. The management in the past was sometimes not able to deliver as per the guidance, and we believe it has now become more cautious in giving a more conservative outlook. Interestingly, we expect the company to show non-linear growth over the next 8 to 12 quarters. With a current FTE base of 2,570, the company believes that it will need not more than another 200 FTEs to double its revenue base. Finally, the company did emphasize on client mining. With 78 existing clients, company's focus will primarily be on maximizing revenue from these relationships rather than seeking new clients. Now, let's dive into a more granular view of company financial performance by examining the quarterly income statement. This will give us insights into its revenue, expenses, and profitability, painting a clearer picture of its current financial standing. As we dive into the quarterly income statement overview, we can see how financial performance has evolved over the last few quarters. This snapshot provides us with a comprehensive view of the revenue and expense dynamics, enabling us to assess the company's health and trajectory. Starting with net revenue from operations, we see a steady increase from $1,176 million in the first quarter of 2025 to $1,332 million in the first quarter of 2026. This revenue growth is higher than expected and partially highlights company's growing ability to execute. Next, the employee expenses have largely remained at $981 million. As a percentage of total revenue, these expenses have improved, decreasing by 220 basis points on YY basis to 73.7%. This indicates better operational efficiency and is expected to contribute further towards margin accretion over the next 24 to 36 months. On the EBITDA front, we observed a significant improvement, with EBITDA margin rising from 9.9% to 12.9% on an annual basis. This is the highest margin reported by the company since business transformation that took place a few years ago. Reported net income during the quarter stood at $127.3 million, which translates to a profit after tax margin of 9.6%. Looking at the annual income statement, we can see how the financial performance has been over the past 7 years. Last 2 years witnessed negligible revenue growth. At the same time, we have seen increase in EBITDA margins. The company did invest a lot in strengthening the execution as well as the leadership team, while establishing presence near client locations during the last financial year, which resulted in margin decline. We have built a conservative model with only 11% annualized growth expectation over the next 3 years, with EBITDA margin expected to reach 11.8% in FY28. This is significantly lower than 12.9% EBITDA margin reported by the company during the most recent quarter. With the employee salaries seeing upward revision during the second quarter, we would like to get more comfort around company's ability to deliver sustained margins before we model a higher margin profile. Currently, we are estimating FY28 EPS of 22 rupees while assuming 1% annual equity. This slide shows a gradual decline in employee and other operating expenses, which are resulting in margin accretion over time. Here is the snapshot of the balance sheet. Now, let's examine the historical trailing 12 months price-to-earnings multiple of the company. Understanding this metric will give us a deeper insight into how the market perceives the company's earnings potential and PE-based valuation over time. An interesting way to look at the valuation of a company in this sector is to see how multiple changes after quarterly results and the kind of commentary that the management gives. We are showing the trailing multiple since 2021, once the business transformation started to take some shape, and hence earlier trailing multiples are not relevant. During this period, the company has traded at a median PE of around 31 times trailing earnings. And with this, we conclude the results review. I hope you found it to be informative.